Let's talk market strategy. Joining us for that is Seema Shah, Chief Strategist at Principal Global Investors. I got depressed reading your notes, Seema. If I wanted to be a bond investor, you give me absolutely nothing. I think you should go into equities, honestly, after reading it. And Jason Trennert, Chief Investment Officer of Private Clients at Glenmede, our guest host, Jason Trennert, Chairman of Strategas Research Partners. Seema, returning to what I was saying, you point out, I mean, there's just no coupons anywhere, and there hasn't been, and any gains made in fixed income have been principal gains, and that's not likely to continue. So is there anything to do in this space to try to minimize your equity exposure? How do you diversify with fixed income where it is right now?
Look, I think it's a really, really difficult position to be in at the moment. We are saying that, you need to look within equities, try and be as defensive as you can, so that's focusing on defensive stocks, defensive sectors, and really looking mainly at mega caps, because there you actually do get some defense against a lot of the volatility. It's also a lot domestically focused, so you manage to get around some of the trade tension issues.
All right, so Jason Trennert has a barbell approach. Let me see if you agree with this. What's your barbell approach?
So the barbell approach is that until there's, I'm not as perhaps as deterministic as Seema, which I do think there are ways out of this, but you actually have to embrace fiscal and a regulatory stimulus to get yourself out of this. Until then, though, it seems to me I'm not that different than you. I think you have to have, we're overweight staples and REITs on the one side and industrials and tech on the other. But it's hard. This move towards value, it seemed to me, is a little premature until you have a real sense that global growth is picking up. And it's hard to see that happening until trade actually is resolved, or Europe and some of the other industrialized countries really embrace more stimulus, aside from just using the same old monetary playbook.
So, Jason, I don't let anyone say cautiously optimistic anymore because it's such a cliched term, but stay long, but be defensive and build protection into your portfolios is your advice.
Yeah, so I don't actually feel like I'm oddly in the consensus, which is not always the place that we are. One of the things I would say is number one, as it relates to fixed income, we prefer cash over fixed income in the allocations, basically because you're actually getting somewhat of a yield on cash, even though those rates have been coming down. Relative with that flat yield curve, cash is the preferred position for straight up best defensive options that you have on the table. Aside from that, it's basically maintain your equity position. This is an ongoing expansion. We see 25% chance of recession within the next 12 months. That's well below 50% still. We are late cycle. There are some risks of recession, but we want to be positioned with equities on a go-forward basis. So if you're going to be doing that, you have to find ways to be defensive. And it's kind of like an approach of smart defensive. You don't want to just blindly build in defensive in the portfolios. Utilities seem like they're overpriced at this point in time. I would say consumer staples probably fall into that camp of overpriced. But, healthcare is kind of interesting. If you look around, energy infrastructure, like the pipeline companies, what used to be the MOPs are now C Corps, kind of an interesting space with stable cash flows, stable earnings, kind of shunned to the side because of the oil cycle recently, but some nice stable businesses. We think there's some smart ways to do that. And then maybe take some incremental risk in here and there. A little bit of EM Asian equities, particularly focused on the consumer. A little bit of dip into small cap and value in order to pick up some edge.
So, Seema, the other point you make is that maybe we've seen the trough in global growth. Are we bouncing off the bottom, or are we actually starting to, as the rate, the second derivative, have we started moving actually higher in terms of growth, or just stopped declining?
No, I actually think that the trough is still to come, but I think it's approaching soon. But I would say, I mean, with regards to kind of where you allocate, the key thing to consider is that as long as you don't see recession as your main scenario for next year, then I think you should actually stay invested. The aim is to be, focus yourself on really quality assets. You're looking at higher quality, so within credit, that's investment grade over high yield. I think there is some space for cyclicals because, as we said, if we think that there is a trough coming, you need to have some exposure to some of those cyclicals. So some of the industrials, for example. On the defensive side, we like REITs because I think even in a low growth, low inflation interest rate environment, REITs should outperform. And then, as I said before, mega caps is really where you're going to get some of that domestic exposure. The one thing I would say is that, look, when you have that barbell approach to having overweight defensives and then also overweight treasuries, you are actually taking a full-on risky bet that the environment is going to get much, much worse. And I think there are some indicators suggesting, at least for the US economy, that there could be a trough approaching. So you have to be careful that you aren't almost becoming more risk focused by having that barbell approach.
But so REITs instead of fixed income or bonds?
Yeah,
So-
we really like REITs. I know it's outperformed very well over the last year and a half or so, but we think that there's still more traction to do there.